Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. There's sort of a theme here today. We talked about why the market surged ahead. We talked about why some stocks are down in relation to the rest of the S&P 500. And for years, investors were advised to have a portfolio of 60% stocks and 40% bonds. But a recent story in the Wall Street Journal said that that strategy had its worst year in generations. So, Frank, is it time to change that, or is that strategy still a good one?
That strategy is just fine. It's nothing is 100%, nothing at all. And it did have a bad year because the stock market went up and interest rates went up, which caused bonds to go down. Actually, and consequently, the bond market was a terrible drag. But this is an abnormal rise in interest rates, as we've said on this show. Mike, I think you've told us in the past that it's never happened before where the interest rates moved this much in such a short period of time. Back in the 70s, they moved more than this, but it took several years, not several months. And that being said, the bond market was particularly bad. And if you looked at last year, it was horrible, which is why as was the stock market. So what you had is both going down at the same time, both markets going down at the same time, which is not the theory behind 60-40. The theory behind it, to explain it, is in theory, as we've been talking earlier, when interest rates are raised like they have been this year, they were raised in order to stem inflation, slow down the economy. The question is, it's not happening fast enough. The economy is questionably slowing down, maybe. All right, finally. And consequently, when that happens, when you slow down the economy, that means the market's been going up, which it has been doing this year. And consequently, now the next thing that will happen is we'll start worrying about the recession that the raising interest rates will do and may cause. And if that happens, then the stock market will go down and interest rates will start going down to stimulate the economy, which causes bonds to go up. So you get a bit of a seesaw in normal times. 22 was not normal, just flat out, it wasn't normal. So it's still a good strategy, and understand that there's all kinds of bonds. You know, you can buy government bonds, you can buy junk bonds, which are less interest rate sensitive, more economically sensitive. And but the 60-40 concept is mathematically sound.
Well, the 60-40 concept, I think that one of the reasons why people write about it is that it is probably the most popular allocation. But it is not, you can't just say to an investor, you should be invested 60-40. I mean, you have to look at risk tolerance. And, at our firm, when we're doing projections for clients and trying to determine what strategy, whether they should have a 60-40, it's based on what their goals are, but it's also based upon their risk tolerance and how much volatility they can stand and what their cash flows are. Because when you're taking money out of a portfolio, you might need a 40-60 allocation versus a 60-40. It's not just a given. But I think the point here is that asset allocation, making a determination of stocks, bonds, it still works. Yes, bonds were down last year, but stocks were down more. So it really is, and to Frank's point, as we get through a normal business cycle, even though bonds were negative, they have the ability to recapture some of those losses. So it's, Stacy, this is like the inflection point when the Wall Street Journal starts writing about throwing away 60-40, it's probably the time to do it.
I can believe
the other important thing that you have to know, if you have bonds in your portfolio and you look at them and you say they're down, are you trading the bonds or are you going to hold them to maturity? If you're holding them to maturity, it really doesn't matter what the value of that portfolio is. If, and this is a big if you're actually going to hold them to maturity and you believe that they are actually going to pay. That's really key. So really the value of a bond portfolio is less important than, say, the value of an equity portfolio, because we don't really know what the value of that company is. Somebody has an idea about it, but like a bond, you know what the par value of the bond is and what it's going to pay. So if you have high quality holdings, you should have an asterisk next to that valuation on those bonds.
Yeah, the problem with last year, Frank brought it up, is that was a once in about a 240-year event last year. So we're not likely going to have that again, hopefully in our lifetimes. So we lived through it. But as Kerry brought up, bonds went down a lot less than stocks last year, but they were correlated with one another, which is the problem when you have bonds in an equity portfolio. The good news is that yields have sort of reset to more quote unquote normalized levels. So you're finally getting paid a little bit to own those bonds, and hopefully those bonds are uncorrelated or less likely to be highly correlated to stocks as we go forward. So I really I think bonds, for the first time in years and years, it actually makes sense to have an okay amount of your portfolio in bonds. Again, given your risk tolerance and your financial objectives, as Kerry mentioned. But when you look at the starting yield of a bond index right now, or a bond mutual fund, or whatever, an individual bond, that should give you a high degree of likelihood of what you will return in that bond holding over the next 5 to 7 years or so. So starting yields in many cases are north of 6%. That's not a bad annualized return over the next 5 to 7 years or so. Again, all else equal, and on a go-forward basis.
We almost out of time on this particular segment, so a very quick answer here. Do most investors hold on to bonds until maturity?
That's a great question. It really depends on the strategy. We tend to buy individual bonds and hold them to maturity when we're trying to match cash flows. When someone is living off their portfolio and wants to have a portfolio that's going to generate, we're pretty certain that income is going to come in from a maturing bond, or they have a need. Where we'll tend to go more with bond mutual funds is in managing risk tolerance over time, where we're not necessarily matching up cash flows. So when people buy individual bonds, they generally, individuals hold them to maturity. Mutual funds trade them. So, that's kind of a difference.
Okay, great. Maybe we'll get into that again in another segment or so. We have to take a break. We'll be back in just a moment.